Mhm.
Everybody, welcome to today's session. This session promises to be a very insightful one. Thank you for joining our financial advisory session today. My name is Boluwatife Udiyomi, and I'm a staff of the Lagos State Employment Trust Fund. I work as the business support officer in this fund. Thank you all for taking your time to join. We'll just would wait for 5 minutes or so to make sure that other people join. But as we are waiting, please just engage in the chat box and then you know introduce each other and then talk about what you people do so that you can network and then make more, expand your network. Thank you very much. Welcome once again to this very insightful session for our chemistry school. So I stated earlier that wanted us to wait for 5 minutes to enable people join and then just increase the number of attendees we have on the session now. And then we have 1 more minute left before we start the session proper. So while we are waiting, I would like for us to just network, state what you are doing. You don't know, you can get your customers from this session, or know the people you network with might have your customers network for you. And then also, that's why we say you network and then you make friends in the chat box. Thank you. So hello once again and good afternoon. It's a very lovely afternoon today. We'll be starting the session proper, and today we'll be speaking on the topic smart businesses, from bookkeeping to business growth. And with us we have our facilitator that will facilitate today's session, and, and his name is Mr. Emmanuel Ayoride. Before Mr. Emmanuel Ayoride comes up, I'm going to tell you a little bit about LSETF. Lagos State Employment Trust Fund was created by the Lagos State Employment Trust Fund Law 2016. And what we do is we create access to finance, we create access to business opportunities, we do capacity building, we give loans, we give grants. And that's basically what we do at Lagos State Employment Trust Fund. For our loan facilities, we have our ME loans, we have our nano loans, we have our MES loans, and we have our SME loans. And for every of our loans, for you to be able to access any of our loans, you have to have your LASRA ID, you have to have your tax ID, you have to be a resident of Lagos State. You don't necessarily have to be an indigene of Lagos State before you can benefit from LSETF. All you just have to do is to be a resident of Lagos State, have a functioning business, and then you can benefit from Lagos State Employment Trust Fund. So before I call Mr. Babaride, I will just be reading his profile before I call him. So Mr. Ayoride Emmanuel is a fellow of the Chartered Institute of Taxation in Nigeria and the Institute of Management Consultants of Nigeria. He is a certified accountant and a tax practitioner, a member of the Chartered Certified Accountants UK, and an associate member of the Nigerian Institute of Management. He has a master's degree from the London Graduate School and a master's in business administration from Ahmadu Bello University Zaria, and a bachelor of science in accounting from the University of Jos. Apologies. His career spanning more than 14 years covers auditing, assurance services, and compliances, tax and accounting services. He is the CEO of Jackson Tax Consulting Firm and is married with kids. Please let us welcome Mr. Emmanuel Babaride Mr. Emmanuel Ayoride. So sorry, Mr. Emmanuel Ayoride to take our session for us. Thank you.
Good morning, good afternoon, everyone. I hope you can hear me. I think
Yes,
the
we
host,
can. Good afternoon.
good afternoon. The host did justice to that introduction, only that she missed out my name. My name is Mr. Emmanuel Ayorende. As she rightly introduced herself, I'm a certified accountant, a a member of the Chartered Institute of Taxation of Nigeria. I have a bachelor's degree in accounting from the University of Jos and also an MBA at Ahmadu Bello University and also a master's from the London Graduate School. I'm married with kids. I'm the CEO of Jason Tax consulting firm. So this morning we are going, host, can you please help me pull up the slide, please? So this morning we are going to dive into a topic titled A Smart Finance from Small Businesses, from Bookkeeping to Business Growth. A Smart Finance for Small Businesses, from Bookkeeping to Business Growth. This topic is very, very wide. It has more, like it encompasses in one. It has 4 different topics in one. And hopefully we'll be able to do justice to that within an hour. So, number 2, let me quickly introduce the introduction. Small businesses are the backbones of many economies, which we know, which some of us belongs to. But they face unique financial challenges that can make it difficult to strive. Understanding these challenges is crucial for business owners to make informed decisions and navigate complex of management efficiency. Navigating this financial scale can be so taxful. So a business owner needs to understand what exactly I'm in for. Take, for example, you are a business owner, because I can read the chart. The one Mr. Abelo was just trying to market himself, like a small business, they are into farming and whatever. Of course, you should know what you want and then set a goal for yourself. Goals. When you talk about this, what's it called? This topic, the word here, the first word here is not just an English word, it's an acronym, SMART, which of course it's very common in a business world. SMART, of course, we are going to be dissecting this very word. It's not smart of English, it's SMART. That is an acronym which stands for you have to be specific, measurable, accurate, relevant, and then time banding. Your goals in business has to be specific. You have to measure it, and then we have to be accurate. You don't set an unrealistic goal for yourself when you are into a business. And then you have to be time bound. You have to project between this time and this time. This is what I intend to achieve. So these are the things we're going to dissect, and we're going to start from the word bookkeeping, which is the smallest of all business activities. Then to when you grow. So maybe in the course of, I don't know how the organizer wants us to understand, maybe in the course of this lecture, if you have any question, you can just note it or drop it on the chat box. And after the session, so that will not take much of our time, after the session, I can take question and answer so that we will be able to cover this topic within the limited minutes provided. I hope you are all getting it. So let's move on. SMART, definition of SMART. In today's business world, setting clear and well-defined goals and objective is critical to ensure organizational growth and success. The word SMART, like I said, is meaning specific, measurable, achievable, reliable, relevant, and then time bounding. Goals have become an essential tool for business to target effective and accurately, to target audience or effectively and accurately. So the SMART, what does that mean? SMART, the S stands for specific. That is, you must define, your goals must be clearly defined. Specific means clear, very clear, not ambiguous. For example, you can say, I want to increase monthly revenue by 10% by selling my product. That means your goal is 10% to increase my monthly revenue by 10%. You are very specific, clear, not ambiguous, that you are not beating around the bush. Then the MDS stands for measurable. Your goal must be measured. You must have a qualitative or I mean, quantitative metrics that you use in measuring your goals. That is include that is M means measurable. That is include qualifiable metrics to track the progress of your goal. For example, you must track your revenue. You say you want to set 10% increase in revenue. Then how do you track your revenue? On a weekly basis, that is, you must check your revenue. Take, for example, this week, I make a revenue of 5 million. The next week, am I progressing? By what effort have I put in to make at least I have doubled or even had to this revenue? So you must have that metrics that you use in tracking that in order to achieve your specific objective. Then the A stands for achievable. You must not set unrealistic objective for yourself. Your objective of your goal must be within the confines of your resources. What is achievable? Take, for example, setting a goals that are realistic and based on your circumstances. You must not set a goal that you know that you cannot. Your capital worth, let's take, for example, your capital worth 5 million, and you are setting a goal of 10 billion for yourself. It's not possible. A realistic is step by step. This, okay, 5 billion. I want to increase my capital from 5 billion to maybe 10 million. At least that one is double it, but not billion or trillion. No. Realistic within your resources. That's achievable. Then relevant. Your goal must in line with your course of business. Your goal must be relevant to your line of business, what you are doing, not your set goals that are not even relating to your business. So you must be relevant, and then your goal must be time bound. That is between now and next first quarter, between now and third quarter, I must achieve this. Time bound. You must give yourself so that at least you know that then if you have not been able to measure it, maybe when you will retracing your step. Why? Then you'll be able to, okay, between now and end of December, that's what I give myself. I still have this, then you'll be able to check. Then that's time bound. Not that you set goals that are not time bound. I just want to increase my revenue 10%. So you don't know till when, that you must give yourself a time. That's what specific is all about. I mean, SMART is all about. So when you now relate this SMART, which is an acronym in the business world, with your financing, as the topic says, a smart finance from business, for small business, from the growth, from the bookkeeping point to the growth level. So now that we have defined what SMART is all about, then what are the key discussion? So like I said this topic has 4 different topics on its own. They just model it together. Like one, business, what is small business, or what are small business? Then the bookkeeping, then finance, and then the growth, that's expansion. So they model it together, and we'll be able to do justice to all this. These are our core discussion for today. So we are starting with small business. What exactly is small business? All of us are into small business, but according to the Nigeria, they categorize small business into 3. So you know where you belong. Small business, as they normally known in Nigeria as MSMEs, that is micro, small, and medium enterprise. That's what they call them. So small business is defined as a privately owned corporation, partnership, or sole proprietorship that have a fewer employee and a less annual revenue. That is 2 things they use in categorizing small business: the number of employee and then the amount of revenue. So if you know, maybe in the course of this, I'm going to break it down for you, then you know where you belong, whether you belong to the micro set, medium, or so. So 2 things that we use in classifying small businesses: number of employee and also the annual revenue. Then the second one is the bookkeeping. What is bookkeeping? Bookkeeping is the process of recording and organizing day-to-day financial transactions of the business. It is worthy to know that bookkeeping is just a step or a branch of accounting, just the first step of accounting. While accounting is an advance, is an interpretation of this raw data, that bookkeeping. Bookkeeping is just a gathering of raw data and then organizing them, and then recording them. while accounting deals with analyzing interpretation of those raw data. And then we will, the accounting part is not covered in this session, but with the bookkeeping, we're going to deal with it also. Then the third step, or the third topic I said, is the financing. What do we understand by finance? Finance is defined as management of money, includes activities such as investing, borrowing, lending, budgeting, savings, and forecasting. So that's which we are also going to be explaining in this lesson. So then the final one is the business growth. At what point would you know that, yes, my business is due for growth? And what are those catalysts that can help you to grow your business, That's what we're going to be discussing this afternoon. So business growth is defined as the process of which a company expands its operation, increase its revenue, and also enhance its market shares. Of course, in a market, we have a lot of participants or a lot of competitors. So you are trying to take hold of part of the market share. Take, for example, you are in a market world. Take, for example, you are in a market. Of course, if you can take more than 50% of the market, you are the market leader. Of course, more than 50% of your market where you belong. When I say market, I don't mean market in Igbo. No, I mean the market where your sector you operate. Like the man on the chart, they said they supply farm products. So they are into agriculture. So some of the listeners or the participants on this chart, some of them are into other different sectors. So if you can project yourself and then target your audience, and then you'll be able to take the largest share of the market, and then you are in the verge of growing your business. So all this is what we're going to be discussing in this topic. So slide 5. So number one now, the small business in Nigeria, which I have defined as micro, small, and medium enterprises. So what is small business? A micro, small, and medium enterprises are backbones of many economies, including Nigerians. They include a wide range of businesses, from small local shops to innovative tech startups. MSMEs play a crucial role in job creation, innovation, and economic diversification. They contribute about 48% of the Nigerian GDP and employ 84% of the company workforce. That's according to the report of PwC, that's Price Water and Cooper, for 2024. So MSME, they are crucial to every economy. In every economy, anywhere in the world, you will find them there, which of course some of us belongs to. We employ 84% of the Nigerian labor force, and then we contributed to 48% to Nigerian GDP. That means we are very, very important, and you guys are very, very important in what you do. Then what are those challenges that MSMEs face? Of course, running a successful MSME in Nigeria is not without challenges, from accessing to finance to regulation hurdles and also other obstacles, which are one, limited access to finance and credit. Of course, if I have to throw it open to everybody, of course, a lot of you will not be able to get access. Thank God to this platform. Of course, before we started this program, the host just introduced what they do. They grant access, to all the small and medium enterprises, and it gave you the condition. These are the criteria. These are the things you need to meet. Of course, thank God for this program. And some of you will be able to at least access or walk up to them and then get access at your own convenience in order to grow your business. So one of the challenges is limited to access, and which LSEFT is trying to bridge that gap. Then another one is the poor recording and financial management, which of course we're going to be talking about today. That's why this topic is also organized. Majority of the MSMEs don't have record. They don't have record bookkeeping. As per se, they don't keep their record. They don't keep proper record, and then we'll have to teach you how to keep your record and what are the advantage or benefit you stand to gain when you keep your record properly. And then one of the challenges is also lack of formal structures. Of course, talking from the CAC point of angle, registration, all those documents, they are not then invoicing system and everything, they are not properly organized because we don't have a regulatory in quote, regulatory bodies that monitors small and medium enterprises, and also poor marketing strategies. Most of us do not have marketing strategies, how to position our business for clients or for opportunities. They lack it. And also unstable power supplies, which of course is not only affecting our business, of course, even individual. We know Nigerian problem, light, NEPA problem is always affecting everybody. And if we can take for example, imagine we have a stable power supply. Of course, half of small and medium scale enterprises, half of their problem is solved because most of us depend on NEPA to operate. The welder, the shop owners, and all those people that are selling petty things, they depend on this to operate. Of course, if we have constant light, half of their problem are solved, and coupled with the access to finance, then they are on the verge of exploding. Then the last one is complex regulatory environment. Of course, tax, multiple tax. Most of us in this business, we pay different taxes, different local government, from local government to state government to federal government. A lot of them, they will always come, multiple tax, and then that's another problem, challenges. So let's define small business so that you know where you fall. Like I said earlier, I said those two things, there are two things that they use in defining MSME by the Nigerian policy of MSMEs. One is the number of employees, and two is their revenue. Then there are in categories. Macro enterprise. Macro enterprise are small size businesses. They usually have a fewer than 10 employees, and their annual turnover is less than 5 million. If your annual turnover, I'm sure you all understand what annual turnover is. That is the turnover you make, that's your sales annually, is less than 5 million, and your number of employees are not up to 10. You are categorized as a macro enterprise. Then the other one is small enterprise. Who are small enterprise? These are also an enterprise that have a number of employees that ranges between 10 to 49. 10 to 49. If you have an employee of less than 50 and your turnover is 50 million per annum, then you are under small enterprise. Then finally, the third category is the medium enterprise. If your employee is above 50 but less than 200, above 50 and less than 200, and your revenue per annum is 500 million, sorry, then you are classified as a medium enterprise. So those are the three categories according to the national policy of MSME. So those are the three categories. By now, you know where you belong under these three categories. So that is all for small business. So let's move on to the bookkeeping and accounting. The bookkeeping and accounting itself. So what are we have defined bookkeeping. We have defined bookkeeping in the slide 2. Then what are the benefits I stand to gain? What are the benefits? They say bookkeeping. Why do I need to keep my book? Why do I need to keep the proper record of all my transactions on a daily record? One, the advantage is accurate financial record. One of the main advantages is the ability to maintain accurate financial record. A well-managed bookkeeping system ensures every financial transaction is documented from invoicing to payroll, providing a clear picture of the financial health. So if you keep your book accurately, if you engage in bookkeeping, so you will be able to maintain accurate financial record from all your transactions. You keep them very well, which going forward, I'm going to teach you how to keep your book stress-free, even without using the software, at least for those that have into macro or small business categories. Then number 2, you are informed. It gives you an informed business decision. By keeping your financial record clean or accurately, you will be able to get an informed business decision on at least what next you need to do. These are my records. You will be able to prepare at least income and expenditure, or P&L, you'll be able to know, okay, this is my revenue. This is where I am as to the operation expenses. This is where I am as to the net profit. This is net profit. And then what do I need to do for me to scale up my business to another level? So you'll be able to make an informed decision about your business. Then the other one is compliance with tax law. If you keep your record straight, one thing about tax is evidence-based. Tax is, you can't just go to tax office and say, this I paid, it's evidence-based. They will never believe you. Evidence-based, if you keep your record and you show them evidence, this is it, this is what I pay, this is what my transaction, they cannot have anything to hold. I mean, or they cannot impose any liability on you. Once you have your record straight and you show them, tax is all about evidence-based, evidence. You show them the proof and this, and they will let you go. That's it. So that is why it is very important for you to keep all your records, keep your accounting record straight and clean. Then the other one is better financial management. So if you have, the advantage is, one of the advantages is also you will be able to manage your finances better. Manage your finances very well when you keep your book, your transaction very okay. Then the fifth one is you support for business growth. So when your business or your book or your transactions are kept, then you have an edge. At least you will be able to have a support for business growth. Because before you can even approach any bank, they will want to see your record. They want to see your statement. They want to see your budget. They want to see your projection before they can even give you any loan. Your balance sheet, what is your position? What is this? They will ask you to go and do all those things. And if you don't have that, you won't be able to even approach bank. That's it. Then the sixth one is you also have a career opportunity in accounting when you keep your, this one is for accounting people or those ones that want to go into the career or the consulting aspect of the accounting. So you have more knowledge in accounting when you keep your book straight. Then finally, it will enhance financial plans. Then when you keep your accounting record straight, it will enhance to boost your financial plans. It will help you plan your money, your finance very well. And these are the advantages that you stand to gain when you keep your book straight and proper. Then the core steps in bookkeeping process. There are processes in bookkeeping. How do I keep my book from the starting point to the final one? So there are stages of bookkeeping. The first one is gathering documents. Documents in the sense that we call them source documents in accounting. Source documents, which are your invoices, your receipts, your bank statements, and other documents. They call them source documents. They must be perfect. Before you have a client and you want to invoice the client, then you must always have a copy, a backup copy. When the client, you send it to the client, acknowledging it, and then you keep it. That's the source document, gathering the source document, all those invoices. And then when the customer comes, you issue a receipt. I think some of us has a receipt booklet, which will have your carbon copy for yourself. So that one is also very good. You keep it for every transaction. So from those source documents is what an accountant will pick and use it to develop your financial or your balance sheet or your P&L and everything. Then the second one after this gathering of source document is recording transaction into journal. To record a transaction into journal, you either do it on an Excel or you apply, or it's advisable to have a accounting software. There are a lot of accounting software that are very cheap and that you can just get online. They're very cheap, and then it will make your reporting or your business okay. Very cheap. QuickBooks, Zoho, then Sage, and some other ones that are very cheap. You just pay one off. Some are one off. Then some you pay subscription on a monthly or a yearly basis. So it will help you. Then that's recording transaction in journal, and then after posting to GL, posting all this from gathering document, all those documents that you gather, all your invoices, what you record as journal. Then All the journal, you will call it as general ledger. All the general ledger is what transforms into reconciliation. Reconciliation is always advisable to do your reconciliation on a daily basis, because if you leave it undone, you might forget. That's reconciliation in the sense that, okay, these are the inflows that enter into my account. Does it really tally with the, for example, for those of us that have sales agents, agent that goes out, they market, they sell your product. But when they want to pay, they pay direct, maybe you use the POS or whatever, the money hits your account. At the end of the day, you must reconcile. This agent went with 30 bags of, let's take for example, cement, and I received alert. I got alerts, at least the alert was coming in. But I need to reconcile. At the end of the day, when he came back with 2 bags. Definitely you should assume that he has sold 28. So by the time you reconcile your bank statement that I must get like 28 alerts or bank transactions from or whatever, or 20 or amount that amount to that 28 bags in my account. So that is reconciliation. The same thing you do to other for other transactions. That's what reconciliation is all about. So it is advisable to reconcile. That's what they do in bank. All those people that have worked in bank, they must reconcile all the transactions before they leave. Otherwise, it become, when it accumulates, they might forget, and then error will start setting in. So that's reconciliation. So after reconciliation, then you make necessary adjustment. That's from the reconciliation is when you discover error, then you adjust. Then at the end of the day, finally, you'll be able to provide your trial balance, which is the last step of the process. Trial balance is from this trial balance that will now extract our profit and loss, cash flow statement, balance sheet, and some other from this trial balance. Trial balance are the balances of all your ledgers. All your ledgers, general ledgers, they are balances. When I talk about general ledger, all transaction in accounting, every transaction must have 2 postings. Take, for example, you have office expenses is one transaction in accounting ledgers. You pay salaries is another transaction. Your sales is another transaction. All of them, the balances at the end of every month that translates to trial balance. And it's from trial balance, you'll be able to make an informed decision that I want to prepare my P&L, profit and loss account, or I want to prepare my balance sheet and other required financial statements. So what are the best practices for effective bookkeeping? There are best practices from effective that is certified by the accounting standards. The best practice is 1, timely recording. Your accounting or the bookkeeping must be timely. That's why there's no delay. That's why I emphasize reconciliation must be done regularly, timely. Then organized documentation. Your document must be well organized and arranged. If you have to provide a folder for every transaction or every transaction head, take for example, a folder for sales. These are my sales record. So you can have a divider if the folder is a big one, divider for January sales, February sales, March sales in a folder. Then purchases, these are my purchases folder. You have everything arranged. Then with all other transactions also that you make, that's your operating expenses, you have all, each folder well arranged. Then it is also advisable to use accounting software for a better reporting. Accounting software, once you post, it will help you to generate all other reporting. Once you post the link correctly, then every other report that you need, accounting software will do it for you. And I was mentioning some of the accounting software that are available. You can quickly buy it off the shelf and just pay a token, and then, or you pay a subscription monthly or yearly. It's just like QuickBooks. I'm sure most of us will be familiar with QuickBooks accounting software, Sage accounting software, ERP, Zoho, and a lot of them. If you Google, you will see a lot of accounting software that you can easily pay for, and they are not that expensive. It will help your business if you employ that. Then another one is regular reconciliation, which I have emphasized in the last slide. Reconciliation is very necessary regularly. Then also internal control. Internal control here means you must separate your operation. Take, for example, separation of of duty. That's what internal control is all about. Controlling. Take, for example, you have a number of employees. You are the CEO, is supposed to be signing all the checks that goes out. But an accountant is in custody of that check. Your accountant can never, that keeps your check book, cannot be a signatory, because otherwise something else will happen. Accountant can just wake up in the morning and sign check and give. So he can keep the money, of course. He can write on your behalf, but the signing and authorization relies on another person. So you can separate all these duties to a lot of people or some few departments. That's why we have Department of Accounting, which is different from the audit department and everything. So that's that, in order to just to checkmate one another. That's the essence of internal control, to checkmate one another. Not that only one person will start by collecting the check, write the check, sign the check, go to the bank and cash it, and the person will run with your money. So it has to be involved different departments, which of course they will have insight into what they are doing. Then the other one is continuous training. You have to train your employee. For us to keep a proper, your employee must at least have a knowledge in accounting. Not that you post wrongly. If you post wrongly, of course, the report is not going to be accurate. What you're supposed to post as purchases, they post it wrongly to another thing. So the report will not. So you need training. Of course, maybe once in a while you can attend something like this. This is how to do this. Something training like this, you need it so that you'll be able to at least handle your posting or handle your transactions yourself. Then the last one is compliance awareness. You must be aware. Compliance awareness, that is, bookkeeping will put you on toe to be compliant in everything, tax compliance, regulatory, and all those things. When you keep a proper record, you will be able to, of course, be compliant. That awareness will come that, okay, I must pay this by the end of, I must pay my VAT on or before 21st of the following month. I must pay my payee for the employment on or before the 10th of the following month. I must pay my withholding tax immediately after deduction, and all those will be compliance awareness. You will know that, okay, these are the regulatory, these are the things I must do, because you keep your record bookkeeping, and you will be compliance awareness. Then the next slide is, what are the common challenges of bookkeeping? Of course, bookkeeping also have challenges from ranging from human errors. That's why he insists on at least you have a training. You must have a training so that you understand human error, just like the errors in accounting, error of omission, error of commission, error of compensation, and all those errors. They are as a result of human being, because it's what you put into the system that will bring out. So you need a training in order to avoid this human error. The other one is incomplete documentation. If your source documents are not complete, there's no way you can get a perfect account P&L or whatever. So that's why accounting starts from the source document, which I have explained earlier. Invoices, receipts, and all those are the source documents used to move on to ledger, journal, and then to trial balance. So if they are not complete, you only have an incomplete record or incomplete P&L. Then the other one is time constraint. Manual posting or manual keeping of record is time consuming. So that's why they have a software that can help you. So for other businesses, they propose that you outsource your accounting department. Though outsourcing is cool, very okay. But of course, it's very okay and it's all cost effective. But at this level, of course, it's something you can do yourself. Most especially if you don't have, you are not a company that has large volume of transactions. Of course, it's something you can handle by yourself. But if you have a large volume of transactions, of course, you can be thinking of outsourcing or getting people to help you manage that aspect for you. Then the other one is reconciliation issue. Of course, we can have reconciliation issue also in bookkeeping. That's why you don't wait. Disparity between bookkeeping and bank statement requires thorough investigation. In accounting, if you are maybe you have an experience, you will see that maybe when you are reconciling, only for you just see that your account is not balanced just because of 1 naira. You will be looking for it, and so probably maybe you have you have kept those reconciliation for months or for weeks before you start. But if you do your reconciliation regularly, of course, it will not be cumbersome, and then you, of course, will always have an headway. Then the last one is lack of expertise. So insufficient training, which I've also emphasized that you need training, because accounting, it's something that is not static. We have laws, we have different rules and regulation, ethics and code that is coming out every now and then. So you need to be up to that game. You need to know what is at stake for now. What are the new laws? How are they saying, or what are they saying on how to treat this, what's it called, the transaction? So you have to be updated. You have to know what exactly you want to do. So that's the end of the challenges in bookkeeping. Then, which will move on to the next slide, the MSME financing and the sources. So financing, there are 4 categories of financing. Your financing can either come internally. Your financing can either come as from the debt financing, that's borrowing. It can either come from personal savings and also alternative financings, which we are also going to be looking at. Alternative, there are a lot of them that are. So let's define what business finance refers to as how business plan to raise and use money to operate and grow. It goes beyond simple bookkeeping, covering fund, capital allocation, or cash flow performance. So it's business finance simply means how you plan to raise your money and then use that money for business operation and growth. So let's move on. Then why business finance matters for growth and survival? Why? It's a business finance. Why is it matter for growth and survival? One, clearer picture of financial health. If you have your business, it gives you what a clearer picture of your financial health. That is, you'll be able to track your profitability and then spot cash flow trends. And also, you'll be able to support strategic decision if you have your business finance in place for growth. So this, you have a clearer picture of your company's financial health. And also the second one is you enhance your cash flow management. Why is it important to enhance your cash flow management? That is, you'll be able to monitor your income and expenditure and also avoid cash flow crunch. Then also you'll be able to plan for growth when you have your business finance. Well, that's when you have your finance. And then the third one is you will streamline your budget and forecast. It will streamline your budget if you plan. That's your business finance. It will streamline your budget and then your forecast. Budget in the sense that this is budget is just a document you prepare on what you intend to do. So you will not be able to, if you are guided by the finance, you will not be able to go above your budget. This is the budget for staff payroll. By the end of January of 2025, we will be able to pay 25 million for staff. So you will know at least January we are still paying 12. Then probably maybe if you want to engage another staff, that you know that the staff or the salary they are requesting for is more than your budget. Of course, it's either you renegotiate or you hire another one that is within your budget. The same goes with your purchases, the same goes with other expenses. So you will be confined within the scope of your budget and then your forecast. Another reason is you have more accurate financial record when you easy tax prep and then stress-free audit and review. So when you have this, you have an accurate record of your finances and also improved financial decision. So your business finance will improve your financial decision. That means you'll be spot on in planning, and then also you support your big decision. If you want to scale up your business or you want to move further, of course, when you have this at the back of your mind, you'll be able to decide what's next for my business. Then the sixth one is it will simplify your tax preparation, which we have said earlier. If you have that awareness that yes, these are the things, these are the regulatory, these are the things I need to do. So you have that consciousness that yes, my tax records will have to be straight. Then also you will have to, it will also reduce the risk and better compliance. That is, adhere to regulation, detect discrepancies early, and then minimize penalties. That is, if you default in any tax, there are penalties associated with it. Every tax payment has a cap date between which I have mentioned earlier. You must pay your VAT on or before 21st of the following month. So you have that consciousness that yes, when I have my VAT has to be paid before that, otherwise there's a penalty. You must remit your pay as you earn for your staff on or before 10th of the following month. Then you know that if I did not, then the penalty, you must do your withholding tax immediately after you deduct your withholding from the supplier. You must remit on or before 7 days. You must do this. You have that consciousness in order to avoid penalty. They said it is easier for you to pay tax, but the penalty or the non-compliance is heavier than compliance because the penalty and the interest that are associated with the non-compliance. So for having this, by having this, what's it called? The business finance, whatever, you have that consciousness of minimizing your penalty. And lastly, you increase productivities and efficiency and also business opportunities. That is, you have increase your productivities when you are guided by this, and then it will also showcase the stability in your business and unlock business opportunities for you. So then the next slide says, what are those steps that you need to take before you decide on funding decision? You don't just rush in. All funding avenues are not they are not avenue or the right avenue for. You need to understand the categories of your business and then understand what you need to do. Number one, you need to research and identify funding source, which we are doing right away. We are going to tell you different sources of funding, and then you now know which one is better for your business based on your levels or categories. Then also you need to prepare a business plan before you approach anybody for funding, a business plan, and also presenting your business plan to your investors or your lender. Number one is you must take time to explore different options and determine which one align with your business goal and requirement. Consider factors such as eligibility, criteria, funding amount, repayment, and then interest. You have to put all those ones into mind before you can approach, okay, this is the best funding source that I'm going for. Then the number two, we say we need to prepare a solid business plan. A solid business plan means that includes one, executive summary, that is you are the CEO, you must have. These are the composition of a business plan. That is a company description, the market analysis, and then the product and services you are selling must be inside your business plan. And then market and sales strategies. How do you intend to recoup that loan that you are trying to apply for? And then the financial projection, it's always come inside that is your projection. You are applying for a 5 million loan, then you must, okay, between January to December, I should be able to earn more than that so that I will be able to repay my loan. And then the fund request, you must state it categorically. And also, when you are presenting, you must have you must clearly articulate your funding needs, how you intend to raise the fund, and then how you intend to pay back is very, very important. So those are the decisions you need to make before you can now approach anybody for business funding. Like I said earlier, I said your business, your sources can either come from different categories. That's 4 categories. Either you're sourcing inside, or you are sourcing from external, that's borrowing, and also you are sourcing from your personal savings, or you want to do an alternative source. So we're going to look at different options for funding. Number one is bank loan, which is very common. Bank loan, like I said in my introductory part of this lecture, I said small and they always have problem in accessing bank loan. Why? Because some of them do not have record, bookkeeping. And banks, their interest is, of course, not competitive at all. It's very high compared to this level, very high. And also they demand collaterals. And most of these small businesses, they don't have collateral. So approaching bank is, of course, unless you have grown, it's not really an option for macro or small businesses because they will demand a lot and then their interest is very, very expensive. Then also this is another one, the venture capital. Venture capitals, they are companies that are interested in investing in startups. They have money that they have gathered from different investors. Then they will now invest that money in startup. We have different venture capitals in Nigeria, like I think you can Google Vehicle, Green, I think Greenhouse Venture, and all those ones. They are venture capital. You can approach them. If you have a very good business idea, you can approach them. They look at it. Of course, they have supported a lot of tech startup companies in Nigeria. Present your proposal, they will help you. But the only problem here is that, of course, they are expecting returns. Their interest is also very high because they know they will support you and what they are after what they stand to gain. That's just it. So then the other option is friends and family, which is also a traditional option. Of course, you have for some of us that have very wealthy friends or close associates, we can approach them. Of course, here the interest some of them might even don't worry about the interest. Don't worry, I will lend you, of course, but just make sure we have a formal documentation on how you're going to repay me. So this is option which is okay for some macro what's it called? Businesses, friends and family, they can loan you startup. Then the other option is crowdfunding. Of course, this has been tested in Nigeria. Most tech startups, they've done crowdfunding. Majority of these new startup in Nigeria, that's techs, they source their money through crowdfunding. And crowdfunding has been gaining traction on social media now. If you have a very good, of course, proposal, you can go on social media, write a very captivating story about your business. Then people can start contributing, fund your listing. Let me just go crowdfunding. There are a lot of crowdfunding, what's it called, websites that you can like GoFundMe, like Kickstarter and some others. You can go there, write a captivating story. These are steps. Set a clear goal for yourself. Tell a compelling story about your product or your companies, and then create emerging content. You employ a content creators. Let them create something for you online and then offer attractive reward. Of course, those people that are crowdfunding, some of them might also what we stand to get. They contribute and then leverage on social media. Crowdfunding is more about social media. If you can gain traction, then maintain communication with them. Compelling stories. Of course, they do crowdfunding for NGOs. Those people that want to do what's it called? Operations and everything. They can give them free NGOs, and most crowdfunding that we have now, those those fintech companies, they benefited, they crowdfunded it, and then they start their business. And then the other source is the angel investors. These ones are a set of investors that are looking for where to put their investment. They are everywhere in Nigeria, of course, they are around too. So what they are looking for is how to invest in startups, in business that are viable. If only you can convince them, they are ready to help you. So they said they are individual that provide financial backings to early stage businesses in exchange for equity. Some of them will say, okay, we will get a percentage in your business, or you'll be paying us interest on a monthly basis or yearly basis. So it's just for you to define your business plan, then build a strong network, then crave an effective pitch, and then seek an angel's investment. They also have like a community, just like crowdfunding. Of course, you can also Google and you have a community where you can also drop your proposal. They review it and then they communicate with you. They fund your business. So this then another source is the government grant and programs. Government grant and then programs. Programs, when I say mean program, I mean competitions. Government grants, which is one of the one that this LSEFT they're doing now. Of course, they grant you, they range from local government to state government, and also federal government also gives grants. So if you want to support a sector, they can give grants, like the one that Lagos State is doing presently. And also like competitions too. These are other avenue that you can also source for loan. Like the one that they are doing currently in Nigeria, the Next Titans. You go to the board, you present your case well. They support you. If you have a genuine case or a genuine business proposal, and they give you tax and you're able to win it, they will support you. Of course, they are reality TV shows. They support you. So that's another avenue. Then the next sources is also, we said, a bootstrapping. Bootstrapping is a method of funding where enterprise use their personal financing, which we have said, to start and grow the business. This approach requires a careful financial management and often involve self-funding through personal savings, credit card, and involve an income from previous job. So bootstrapping is more or less like personal saving. You self-finance your business, maybe from your savings or your previous employment. They give you what's it called, gratuity. Then you use it to start up your business. So here you don't have any issue of interest or issue of any repayment. It's your business, it's your loan. I mean, it's your money that you put in. Then that one is more safer, and this category is where most startup or macro and medium enterprises fall on. They try and strive to save some money to start business, which of course is not ideal. That's why they cannot grow beyond that scope. Then the other one is strategic partnership, which is closer to meeting an individual. So this strategic partnership source is what most accounting firm, law firm, taxation company, businesses, they are doing. Take for example, I'm a certified tax. I have my firm, and I have a friend that has an accounting firm. We can partner. Here, I bring my resources, and then we join. Most of the law firm. That's how Akitola Williams started. They partner, all these small accounting firms, they partner together, and here, this is where they are today. They are grown. So the same thing, this is the strategy that most law firms too. This single law firm, they can come together, and then you see them partner together, and then they grow. They bring their resources, they bring their expertise, and also contribute to. So that's another avenue of also source for fund. So this one, you don't really need money. You just come with your idea and then come with your. So another, then the last one said alternative sources, peer-to-peer lending. Peer-to-peer lending, this non-conventional funding that connects borrower directly to individual without any intermediary. Peer-to-peer, that's P2P lending, is a social lending leverage online platform to connect borrower to lender. This one is also leveraging on platform. They have also a platform where they connect you. You drop your story. I want this. This is what I do. This is what I need money. Then from all those people, they connect you. For those ones that are meet your need, they connect you together. Okay, this person said he has 10 million that he wants to invest, and you need 10 million, or you want 10 million for your business. They connect you together, and then you agree on the repayment and the means, how to repay, and then how that mutual connection can benefit both parties. Then another source is revenue-based financing. This one is more or less like they call it MCA, merchant cash advance. If you are in a business where you have a huge receivables, when I talk about receivable, that is a lot of people are owing you outside. Of course, they acknowledge by giving you a note. They are owing you outside, which you know that they are owing you. But you can convert that note or receivable to money. you can convert it to money. Of course, just go and meet the right place. Go to the right place and present that note that, okay, Mr. X is owing me X amount, 10 billion, and they plan to pay by December, but I cannot wait until this maturity date. So I need, if you can give me 9 million, then the other million is an interest, then you hold on to this document when Mr. X will now pay you in 10 million by December. So that's merchant cash advance. So that's another option. That's an alternative option. You can convert your receivable to source of fund. Then the next one is bank accounts. Most of the micro bank, then they don't have an account. Thanks to these new fintech companies that they are trying to spread all over the place. That's the likes of OPay, the likes of MoneyPoint, that they are trying to meet all these new, these small businesses that enforce them to at least open a bank account. By opening a bank account, you can easily get a quick loan. You can easily get an overdraft or even small thing. At least some of them are advertising in 1 million, less than a million. So by opening a bank account, provided that your revenue is going into that account, and which of course they can use as collateral for you. So you don't need to bring collateral, because you have guaranteed them that, of course, all my revenue, all my sales will be coming into that bank. Then from there, they will be deducting it. In no time, you will pay off your loan. So it's very important to open a bank account when you are operating any business, because there are advantages, quick loan, overdraft, and some other things. You can even overdraw your account as long as it is agreement between you and the banker. Of course, you can get it. It's very important to have. That's another means of alternative fund options. Then the other alternative is creative invoicing idea. All these ones are another options which are not really popular among the macro, but for companies. Some companies does this invoicing, creative invoicing. They say invoicing financing is also known as receivable in financing. That is, here businesses can get an advance an advance on their outstanding invoices. Businesses can receive a percentage of this invoicing amount upfront from a financing company, which I have explained in the other one, the the first one I explained, the merchant MCA, merchant cash advance. So this one too, you can also meet a financing company that you have a lot of receivables that are outstanding or they are pending for you, but you need a fund, immediate fund to run your operation, that they can hold on to these invoices or notes, receivables, credit notes that your customers are giving you, assuring that they will pay in a future date. So you can give it to them, and then they will give you the loan, and while they wait for that maturity date. Then also another option is equipment financing. This one also works for some companies. Instead of you that you approach, you need an equipment for your operation, but you don't have it. They say equipment financing allows the business to acquire a necessary equipment and machine without making a large upfront payment. So you go and meet, you give you that equipment. Let's say, for example, a plant that you need for your operation. So once you get that plant, then you say, okay, you'll be paying instrumentally or whatever. But that equipment financing, that company, those companies that does the equipment, they collateralize that very equipment. That is, this equipment is under collateral. While you are using it, you have agreed on terms of payments. Okay, you'll be paying excess amount on so on a monthly basis. But if you default, they will come and pick up that equipment. But you know what is at stake. You will not want to default. But that equipment, you can be using it to generate your income while you are still paying. So this one is more secure. And this is what most of the companies in Nigeria, this is what they do. that all these construction companies, that's what they do. The Julius Berger lights and everything, they do equipment financing. Most of the equipment that you see is not their own. They are on loan. While they are using it for it, they are still paying on it. So at the end of the day, that equipment, you can also use it to reduce your tax liability, because at that equipment, you can take like capital allowance on it, which of course is part of the means of reducing your tax liability. So because if you purchase an equipment, the law says you can take a capital allowance relief on that equipment. So you can still use it to reduce your tax liability. So this equipment financing is what most companies does. So because there are three ways benefits. One, you will not have to pay cash to purchase the equipment. So while you are paying the loan, the equipment is making money for you because you are using it. And also you can also gain tax advantage on that very equipment. So that's another option that is also available. And then the last option, which is the microloans. Microloans, the small and loans are typically provided by non-profit organizations, community development, financial, and or certain micro finance institutions. So here, these ones are macro financing. We have more than 100 or even 1,000 microfinance institutions in Nigeria. Some of them provide macro loans to us. So you can also approach them for soft loan, which of course is also available. So these are various options you need to consider before you take, there are various options for funding. So you need to also consider what kind of options that are very good for your business before you approach any of this or you want to decide on any of these options. So this leads us to the last from our lesson, that's the growth or expansion aspect of our business. So what is growth? Growth simply means scalability, that is ability to expand your business. Scalability refers to your business ability to grow without being hampered by its structure or availability or available resources. That is ability to grow without being hampered by a structure or resources. That's you scale, you move higher. That's what. So successful scaling requires careful planning, strategic investment, and focus on maintaining quality customer satisfaction. Before you can grow, you need to satisfy your customer. It is better you satisfy the customer you own now than going for a new one. That is just a wise advice, because the one that you hold, it costs more to attract another customer than keeping the one you have. So customer satisfaction in small business is very key, because one, for those ones that you retain, they will either introduce their family, introduce their friends to you. If they have a very good experience with you, they want to introduce people to come and enjoy with you, than leaving them with bad experience, which of course they can spoil your business, than going for, okay, we have another, let me go for it. It's not cost effective to maintain to go for another customer than to keep the one you have. So it is very advisable for you to keep your customer. Customer experience is very key before when you want to scale your business. Then building a strong foundation, that's those things that you need to consider before you can scale. One, you need to build a strong foundation, build solid business model. That is, your business model has to be solid. Ensure your business model is scalable. That is, your business model, this is what I'm doing, this is my model of business. Is this scalable? Take for example a shoemaker that his business model is to run from Ikoyi to VI looking for Uwe. No, you can't scale by that. No target, you are just running everywhere. No target audience, you don't have a specific audience or the target market that you are just moving around. You can't scale with that business model. So you must make sure that your business model at least fitting. You must be able to scale, and then you must also ensure that your business model will be able to scale without additional cost. If you have to scale I mean, if you have to scale up your business by adding more cost to yourself, that means that's not growth. That's not growth. So review your product, service, and price strategy to ensure that you can support growth. So that's number one. Then you must also efficient process, that is, streamline your operational to eliminate inefficiency. Inefficiencies is what takes more of your operational expenses. If you can streamline your, that is, cut off unnecessary expenses, then you should be able to, of course, grow your business. Then strong leadership team. You must also build a team. Like, you cannot grow alone. Of course, you have to carry your employee and other staffs along that want to grow. So you must prepare their mind that this is the next phase of our plan. We want to grow. So if you build a leadership team that can manage your growth, this includes hiring experienced manager, delegating responsibility, and focusing on cultural and focusing on culture of accountability. So that's when you will grow. You focus on culture of accountability and also develop an experienced team that will manage your growth. When you grow, growing is another level. You are not on the same level that you are. So of course you will meet another level. You are going to another level. That is another entire operation. So you need an experienced people that will help you sustain that level, and also develop growth strategy. Market research. Then conduct a thorough market research to identify growth opportunity, understand your target market and customer needs and emerging trend. So you must understand your target market. This is the target market. This is the portion I want to take from this market. And then your customer needs. What do they want? What do they want? Not that you want to grow just for the sake of growing. No. These are the market, these are the customer, and these are their needs. You must be able to meet it. And then the product and service that you want to grow, you must consider expanding your product and services offering. This could involve launching a new product, entering new market, and then adding complementary services. So your product and service, or whatever you are telling, you must distinguish yourself. Of course, the business world is a competitive world. Business environment is competitive. You cannot say you are the only one or monopoly. You want to have a monopoly of business. No, you have competitive, but you must make sure that your product is different. Like one of the products in Nigeria, if you mention the name now, you know, of course, this one. Their slogan is "The difference is clear." 7-Up. The difference is clear when you take 7-Up. Of course, Coca-Cola is different from other Coca-Cola products. So you must make your product different, unique, that people will know that, yeah, this product is no. When you're talking about all this category, this one is unique, is outstanding. So you must design your product to be like that before you grow. Then the customer acquisition. Develop a customer acquisition strategy that can be scaled. This includes optimizing marketing channel, investing in customer relationship, and also tools, and leverage on data analytics to identify high volume customers. So you have to leverage on data analytics to know which of the customers are merchants, those ones that only their sales, of course, you are comfortable, not just petty money. Of course, it's petty drop. It's still something, but at least you must be able to differentiate your customers. These are customers that are of high standard. These are the target market. These are the people that I'm going for. You understand? So that is how to scale up. Then the next is to optimize operation. You must also automate your process if you want to scale. If you want to scale, you must automate your process. Then also focus on financial management, which we have stressed enough on this lecture. Then also strengthen your brand. Your brand is your quality, your image. If you have a product that you sell, you must strengthen your brand. Let them know your brand. This brand is different from, even if you are selling a farm product, the way you sell it should be different from others. The way you sell it, they know that this man, the way he delivers this product to me, no, they package it well, not that you just put it in black nylon and then, no, they package it for those market products that are perishable. You package them in a very ziploc, very neatly, and then they will always call for you. People like when they have a unique brand, product. This is unique from others. Of course, we have seen pure water, we have seen bottled water, but this very bottled water is very unique, different from others. We have seen soft drink or malt drink, but this one is the way if you taste it, apart from the taste and the packaging itself is something else. So you must cultivate that habit to make your brand unique when you want to scale your business. Then how do you want to scale? At what point will you realize that, yes, my business is due for scaling? So there are two metrics you need to consider before you conclude that, yes, I am due for scaling, which I call the quantitative and the qualitative metrics. Quantitative and qualitative metrics. Quantitative in the sense that this quantitative, you can measure it. They are as a result of financial record that you keep. So by the time you check them, you know that, yes, I am making progress. They are quantitative. While qualitatives are the word of mouth, and they are more or less like a mental ability. Are you ready to scale? They are more or less like mental ability. You prepare your team, you have mental ability, those ones are qualitative. So we are going to be dealing with it one after the other. Number one metric is your revenue growth. Revenue growth. The metrics measures how quickly your business is increasing in terms of sales. That is, you must make sure, check your revenue growth. Every growth is not growth. There are arithmetic progression growth, there are geometric growth, and there are undulating growth. You mean you grow, you fall, you grow, you fall. No, but growth steadily is your business or revenue growing steadily. So how do you measure that? One, that's current period. That is, if you want to measure your business, let's take, for example, January to February and March, the first quarter. So the current revenue, that's January revenue. If you want to know the difference between if you are growing, the revenue you make in January and the one in the February, you deduct it, take the difference, and then divide it by the base month, that's the January. Divide the difference of January and February by the January, then multiply it by 100. Then you know the percentage growth of your revenue. That is January revenue minus February revenue divided by January revenue. Then if times 100, then you know the percentage that you have moved from January to February. Then do the same thing with February and March. Do the same thing with March and April, just like that. Then you know whether your growth is undulating or geometric or arithmetic. Then you know the progression. So that one you have to consider before you think of scaling. Then the second one is profit margin. What is my profit margin? Am I really making profit? Profit is divided into, profit margin can be divided into two: the gross profit margin, net profit margin, and then operating profit margin. So those are the things, those ones you need to consider them one after the other. The gross profit margin is just the difference between the sales and then the cost of sales times 100 times 100. That's the gross profit. Then the net profit is your net profit margin. That's the cost gross profit. And then when you deduct all your operating expenses, then you arrive at the rest profit. Then you calculate your profit margin to know whether you are making a progressive profit or you are making loss. Then you can decide whether I am ready for my business. Then the third one is customer acquisition cost. Like I mentioned, it is easier or it is beneficial to retain your old customer than to be chasing for the new one that you don't know. Customer acquisition, CAC, is the total cost of acquiring a new customer, including marketing and sales expenses. Before you can attract one customer, you must do marketing, talk and talk and talk. Before expanding, it is crucial to understand how much it costs to bring in a new customer and whether this cost is sustainable. Can you maintain it? So you need to know how much it costs for me to get this one customer. Can I sustain it? That's it. or I should just keep those customers that I have, service them well, so that at least they can bring in most customers. So you must also consider your cost of customer cost of acquisition. What it costs for you to convince one customer to come and buy. So then the next one is lifetime value of customer. Is also very important. You also have to consider that one too. The lifetime value of customers, that is ability to retain your customer for a long period of time, is also very important. Then the fifth one is your cash flow. How healthy is your cash flow? The cash flow we're talking about here is divided into three: the investing, financing, and operational cash flow. How healthy are they? Cash flow here measures the cash and cash equivalent of your transaction. At the end of every financial year, how much comes in and how much goes out? Am I making profit? That you have to also consider that. Then the other one is the market demand. The market demand. How are we, as in, do we have more customers? That probably maybe, okay, we are in an average market demand. Are we getting more orders that we were unable to meet? That's market. Do we have more demand than we have presently? Then you need to consider that before you think of scaling your business. Then customer satisfaction or retention, which I have mentioned, and then operational efficiency. How efficient are we in operation? Operational efficiency means ability to reduce costs to maximize your profit. That is, you are using small amounts of money, expending operational, as an operational cost, but you were gaining or to sell more, maximize profit. Are we efficient enough, or are we lavishing our money? So those things you need to consider also. And then you must also consider your debt level. Wow, what kind of financing am I operating? Am I in debt presently? Am I owing? Or my equity to debt, what ratio are they? Equity to debt ratio, that is the equity is your total asset, what? And then the debt, are they equal? Are they 1 to 2 or 5 to? If your liability or debt is more than the equity in ratio, then you are not ready for scaling. So don't even try it, because you are going to fall. Don't try it. If your liability or the debt you are servicing is more than your equity, you are not ready to scale, to grow. So you need to also check that. Then also, finally, we move on to the qualitative. Qualitative is more all about mental health, mental ability. It's not only about quantity or quantifiable metrics or those ones that we can, but you need to prepare yourself as the CEO or the owner, and also prepare your staff that yes, the next level we are scaling. If you are scaling alone, you have you are prepared yourself, but you did not prepare your manager around you, then they will pull you back. So while the metrics above are essential, that's the qualitative, it is also important to consider qualitative factors that might impact your decision to expand. This could include your personal readiness for challenging of scaling, and then readiness of your team, and then the potential impact of your company's culture. Expanding a business isn't just about numbers. It's about making sure that your team and your business are truly ready for the journey ahead. You must prepare them mentally that yes, we need to expand. We are going to another location. We are going to another country. We are expanding our business. We are moving to another market. So you must prepare your mind, readiness, because we are going to meet another challenges there. Then expanding a small business is an exciting milestone that can lead to a new opportunities and increasing profitability. However, it is a step that should never be taken lightly. Be careful, analyze the key metrics outlined above. You can make a well-informed decision that position your business for a long-time success. When you analyze the qualitative and then the quantitative one, then you can now make an informed decision. Remember, expansion is not just about growing bigger, it's about growing smarter, which is one of our topics. It's not just about growing bigger, but growing smarter. You must be efficient in your expansion. Not that you are expanding and wasting money. You must spend less to expand. Spend less in having it at the back of your mind that you will gain more or you have more sales, but not just spend more to expand and then you have less sales or less revenue. So you must expand with sense or smartly, as they've told us. So in conclusion, accurate financial record keeping is crucial for small businesses, which helps to track income, expenses, and cash flow. On the other hand, cash flow is the lifeblood of a business. Without it, businesses cannot survive. Effective cash flow management is vital for small businesses to ensure liquidity are met and financial obligations are also met. A smart business owner must understand the right source of finance or fund suitable for his businesses to scale to the next level and go for it. Successful scaling requires careful planning, strategic investment, and a focus on maintaining quality and customer satisfaction. So that is an advice. If you want to scale up successfully, you must plan it strategically and also focus on maintaining quality in your product and also customer satisfaction. So that comes to the end of our lesson. Thank you. So back to you, the host. Question and answer.
Thank you so much, Mr. Emmanuel. Please, if you have any questions, please, you can raise up your hand or just type it in the chat box so that we can read it. And please, I'll be launching a poll on your screen now. Please kindly fill the poll as we take our questions and answers. Please, a poll is on your screen right now. Please kindly fill the poll. It will help us serve you better. And if you have any questions, please kindly raise your hands or type it in the chat box so I can read it out to you. Do we have any questions? Please fill the poll that's been launched on your screen, please. Thank you very much. Is on your screen. Okay. So Miss Rashidat, we can hear you now, you can speak.
Okay, good afternoon.
Good afternoon.
Thank you so much to Mr. Emmanuel Ayorinde. Thank you for the insightful session. So for my own business, we do home delivery of farm produce. And because they are perishables, we do not store much. We only store farm produce like gari, elubo, and so on. So on a day to delivery, we get some non-fast perishable items like tomatoes, peppers, and so on. And then on delivery day, very early, we get leafy vegetables and other things that can easily spoil. So, and then we buy fuel and all that. So it makes it a little bit difficult to track expenses because we collect money in lump sum. Let's say, for example, 100K, and then we start making purchases, we start buying. Most of all those mala, they don't collect transfer. Some of them collect, some of them don't collect. So by the time we finish the whole delivery, that's when we now have to sit down and look at how we have spent. Sometimes we cannot remember, where is this 4,000? Where is this 3,000? Where is this 1,000? But although it has gotten better, we are trying to write it down immediately after we buy. But still, some boys can just come, all those things that I cannot even just remember that you spend this money. Then after the whole delivery, I now try to balance the account to see if the last delivery we did, if it was profitable or not. So I have a formula that I use, because if I try to do plus and minus of what we bought and what we sold, I would forget that I took some stock in the ones that we have bought before. So I would think, oh, we made so much money. I would have forgotten that probably we took Gavi or we took Elubo. So I now have a formula that I use so that I won't forget anything. Or if I'm owing a particular mala or something, I would remember if I use that formula. So if I use that formula, I would see our profits, I would see our expenses and everything. But I would not be able to input it into a software, because the formula is my own. I created it. The software cannot give me the formula, so I cannot have a balance sheet or income statement. Or I have two questions. That's my first question. So I don't even know the software to use that can work for me, because that accounting sometimes it takes my whole day. Then secondly, my second question is that sometimes when money is invested into the business, for example, for advertisement, or maybe probably I just borrowed money from someone, let's say 200,000, and we use the money for a month, I will not see the money again. I will not know how the money disappeared in the business. I know that the money was spent on the business. I did not spend it on myself, but I will not even know how to track that money. So those are my two questions. Thank you so much, sir.
You're welcome, madam. The first question, let me start with the second question. In business, madam, there is no, let me say, friend. You must be ability to separate my personal money from my business money. It's what makes business business. When you borrow a loan, it's a loan which you must pay back. You don't have to tamper with it. And you must, of course, you, like we said before, you have a need for fund, you must have at least matured out your point. What are those things? What is the need? What do I really need this fund? Yes, these are the things I want to channel those funds to. Of course, you must have matured out your point. So don't borrow because you want to spend on yourself. No, you are borrowing for the business, and that thing must go to the business. So that's why ability to differentiate your personal money, even if you are putting your personal money in your business, it's a loan to the business, which of course the business must either pay you back or you get in form of equity or whatever. So business is different from Mrs. Rashida Bello. Your business they are two different things. So anytime you borrow money, make sure they use it for the purpose for which you borrow that business. If it is your personal use, fine. That one does not concern business. But if it is for business, you borrow to buy some things. Of course, you buy it, and then the gain or the proceed or sales from those things, you should take it, remove it, and then use it to refund the person that you borrowed from. That's just it. So that's why bookkeeping in business is very, very vital. Going to your first question, if you go to the market, even if it is just get a notebook, Agbero, come, write it, Agbero, 1 naira. Of course, you can't go with your system to the market now, but at least always make sure you go with a jota, small jota, anything, transport, 1 naira, put it. Alabaru, 2 naira, put it. By the time you settle down, then you will be able to, at least before you go, you have your purse. Cash at hand, you put it there. I'm going to the market with 700 naira. So the first you enter to the bus, transport to market, 1 naira. So you have to, by the time you come back, you'll be able to you must be able to match up all your expenses. Then you settle that, and then if you are using a software or you are still using an Excel, of course, there are an Excel. I don't know if you understand, you can use an Excel, which Excel version of Microsoft. Then you have it in your template, you list all of them. So at the end of the day, that Excel, you can accommodate a lot of transactions. multiple transactions. Each tab, one tab for January, put it Excel. That's number one, the first row. Income, this. Then each of your expenses, just be recording it. But if you have the safer way, if you have a bank account and you do transfer, thank God, even on your phone, there is a narration aspect under your phone before you transfer. Type the purpose inside that narration before you transfer or pay anybody. If for those ones that collect for the purchase of tomatoes, you will see it there. At least bank what's it called, statement does not lie. By the time you print your bank statement or get your bank statement, you'll be able to know, remember, okay, this one is for purchase of tomato, this is one for payment of electricity, this one is for, you just put it in narration, which is even easier for those of us that have bank. So before you pay, then for those people that paid into your account, of course, that one will appear on the credit side of the bank statement. But if possible, they can put narration there. Sales, or if it is loan from a friend, they transfer to your account, let them put it there, loan. Then by the time you pick up your bank statement, of course, the bank statement is your source document, which they will use in preparing you. So from there, it is the narration is very clear, and they will be accountant or whatever, you will be able to pick it from the bank statement and then put it there. But if you cannot use bank statement or you don't have bank, make sure you go to your market or whatever with at least a jotter. Anything you write for that day, jotter and a pen, just put it rough. By the time you go, I could remember when I was small, I used to follow my mother to the market. Of course, she will come with at least one paper and biro. You will see her writing, and she will keep it. You see her at the end of the day when she gets home, she will now sit down and be calculating. Oh, okay, this one, this one, this is the money. She will do the reconciliation there. Now, okay, I did not overspend. I did not spend my money. I did not do so. From there, so that's just the habit you should cultivate. This is bookkeeping is very essential, and you can't compromise it. It will help your business if you have your record straight. At least you will know how and when not to spend, and how how to spend and when not to spend. So that's just it. I hope I have answered your question now. Then for the accounting software, there are a lot of them. I think the cheapest one for now is either you use QuickBooks, which of course for now is very cheap. You can also meet some other people. Sage is a bit expensive, but QuickBooks, you can even see the crack version live. So for some people that have it, they can share multiple users with you. You can only pay subscription for those people, and it's very cheap. I think it's less than maybe 3,000 naira subscription for those ones that have like a friend of mine that does it. 3,000 naira subscription on a monthly basis, and then you have your accounting record prepared. So that's just it. You don't need to bother yourself about preparing. Once you have your market write up, whenever you go, then go home and then put it. QuickBook is very easy to learn, even if you are not an accountant. Once they put you through, it's very straightforward, very, very straightforward to learn, to understand better. So QuickBook, I will recommend QuickBook for you if you can just get it. Or if you don't have that money now, then just use normal Excel, Microsoft Excel, to document your payment and your receipt for now. Then if you want an accountant can pick up that Microsoft Excel with your bank statement information to prepare your account for you. Thank you.
Thank you very much, sir. Yes.
Thank you very much. Thank you very much, Mr. Emmanuel, for this very insightful session. Thank you, our participants, for joining this session. And I'm sure you've learned a lot. It's very important to do your keeping. It's very important to keep accounts. It's very important to keep accounts because of even when you want to file your tax, when you want to pay your taxes, so you know what you've done and then how to calculate these taxes, and then you can be able to pay them, and then you have good financial records for your business. So is there still anybody that still has the question? If you have any question, please kindly indicate in the chat box or raise your hands, and then will call you. Mhm. Please kindly fill the poll on your screen. The poll is still on the screen, so you should see it. In the absence of no question, we would like to call it a day. Please do have a wonderful day ahead, and thank you very much for joining our session. See you same time next week, and for our masterclass, which is coming up next week on the 29th, please do endeavor to join our session. Thank you so much for joining our session today. Have a great day. Bye.